Hi, I'm Brian House with Frazier Financial. I'm here with Josh Frazier, our Chief Investment Officer. Thought we would talk about the stock market. I'm sure that's on everybody's mind. The number one question we get from clients we'll address first. Am I going to be okay? Josh, people going to be okay?
So the short answer is you're going to be okay. We plan for this kind of market. We've seen them before. It's pretty easy to get pessimistic looking at media headlines or logging and looking at your account value. Brian and I and all of our team members own the same things our clients do. So we feel the pain with you. And markets are obviously down in general. So we'll get through this together. We've got a lot of information as we go along here. So for the clients who like all the details, stay tuned because there's a lot in there.
So we talk a lot to clients who are adding to their accounts about this being a buying opportunity. I think that's pretty easy logic. What about people who are in withdrawal mode? How should they think about this?
Like you said, people who are adding to their accounts, this is a once in a decade opportunity. Prices have come down. A lot of the parts of the market look really attractive to us from a valuation standpoint. So when you're making your buys today, 5, 10, 20 years from now, you can be pretty excited about your entry point. People who are in withdrawal mode, obviously slightly different. They're not adding to their accounts. But when we build portfolios, we want them to be durable for lots of different outcomes. And so when the markets go down, we typically have things to go to for income needs, so we don't have to sell stocks when they're down. So parts of our portfolio are working this year. We have several funds that are actually flat or even positive. So if you're in withdrawal mode, we plan for down markets. And also the bond side of the portfolio has gotten really, really attractive recently. And for a lot of our retired clients, that's 30 or 40% of their portfolio. But we'll talk more about bonds here in a minute.
So at a high level, Josh, stocks have sold off quite a bit in the last week or two. Today is September 26th. So we've gotten back to levels from June, which is when we sent out our last video. Kind of just walk us through the high level. Where do we sit today?
So the market went down about 20% and bottomed in June of this year, right around the time we sent out our last commentary. And the markets rallied a little bit through the summer, got back maybe half those losses. And then over the last couple of weeks, the market's gotten a lot more worried about inflation, interest rate increases, so now we're back to where we were in June.
All right, Josh, I'll ask you a question, but I'll answer it first. The Fed is driving so much of the market news. Can you talk more about that? Why are they driving all of the market reactions?
So the Federal Reserve's job is to keep prices stable and employment strong. And right now we're having price increases, also known as inflation. And so the Federal Reserve is trying to get inflation under control and reduce it. The way they do that is through increasing interest rates, but it's a really blunt tool. It's not a very precise tool. So what it does is just cool down the economy in general and cause people to spend a little bit less money, maybe cause the housing market to cool off and not go up as much as it has been. So they're trying to thread a needle of cooling the economy down enough to reduce inflation, but not making the economy contract so much that we go into a recession.
So you mentioned we're down 20-25%. Are we in a bear market? Are we in a correction?
So the media likes to call a 10% decline a correction, and then you get to the minus 20%, then that's called a bear market. So as of today, we've just slightly tipped into that bear market territory, but we've seen many of these markets in the past. Not every correction turns into a bear market, and every bear market looks a little bit different. But when we go into a recession, it's not uncommon for the market to go down around 30% on average, sometimes more, sometimes less. So we're down a little more than 20%. So we've probably gone through a lot of the worst, but it's hard to predict where we'll go from here.
So I think one of the things that financial advisors do for clients is remind you to think of the long term. We know that there's going to be positives ahead. It can be a little hard to see that far down the road. So what does a year look like after a bear market, or 2 years after a bear market historically?
Returns after the market goes down are usually good. So on average, stocks do about 40% better than they normally do coming out of a correction or a bear market. So the fact that we're already in a bear market a year from now would not be surprising at all to see the stock market do really well. Obviously, that's not guaranteed, and there's time periods where that hasn't worked, but on average, that's been where the market goes.
So recently, investing has been pretty easy. All of our clients' accounts had really good returns in the later part of 2020 and 21. We all saw headlines around cryptocurrencies and AMC stock and meme stocks. It was been kind of easy for a couple years until this year. So Josh, put this in context. Is this a normal part of investing? Is it something that's going to go on forever, or are people going to see light at the end of the tunnel?
One of our clients has a quote in their email signature, and it made me think of this market. And it says, there are no shortcuts to anywhere worth going. And that made me think a lot about investing. So stocks do 9 or 10% annualized returns, which leads to great outcomes over long periods of time. But the reason you're able to get such strong returns is because in the short term, the markets can be bumpy. And a lot of times you are making your money in the down market, not the up market. So today, it's tempting to try to take a shortcut, say go to cash or pull the plug on your investment account just because you're scared. But that's not a great strategy, and that does not reward investors over the long term. So the ones that can stay the course are the ones that are rewarded with those great long-term returns.
So a big part of our role as advisors and your investment advisors is to stay between you and making a bad decision. And investing requires a little bit of intestinal fortitude when things get rocky. So we have this chart up on the screen. Josh, talk about these bar charts in front of us.
So talking about shortcuts again, the average investor gets less than half the return of the market over the last 20 years. And if you ran this even longer time frames, that's also true. And the reason people get this so wrong is they act emotionally and they end up selling when things are low and they get back in once the market recovers. And so you're much better off staying the course and knowing that down markets are just part of the process.
People are eating their vegetables right now.
Eating their vegetables, you're doing your time in the gym so that you feel healthy and fit after you do that. But on the back end of this correction, it could be 6 months, 12 months, year and a half. We'll look back and realize this was a great buying opportunity and also pretty bad time to be making panic sells or decisions.
Back in our June video, we talked about a recession, talked about how we define recessions, how the government defines recessions. So in June, we were not in a recession. Today, officially, we are not. Have things changed in the last 3 months on a recession?
We mentioned in the past video that a recession commonly is defined as 2 negative quarters of real GDP growth, but it's actually decided by 8 people who get together in a room. None of them are elected. They're all picked by one professor, and there are other economists and professors that are making up the 8 people, and they decide months later if we were actually in a recession or not. So we'll find out, maybe in 6 months if we're in a recession right now. I think it's somewhat of a matter of semantics or jargon or things like that. I don't think it really matters too much if we're in a recession or not when we look at investing. So from a recession standpoint, they usually last about 10 months. So like my last video said, expansions are a lot longer than recessions typically in the US. And so if we are in a recession, we may be 6 to 9 months already into that. So I'm not saying we're at the end of the recession. I'm saying we've already endured some of the downturn already. So there could be light at the end of the tunnel.
So Josh and I talk to clients all the time, and the most common question that I get around markets is if we can predict when things are going to be at a peak or at a bottom. Everyone that works with us has heard us say that that's not possible. So we didn't see this coming in the sense that you can predict markets in which direction they're going to go, but we do prepare for it. So Josh, you want to unpack that a little bit? We're not predicting things, but how do we prepare for them?
So we thought interest rates would go up, so we did things within our bond portfolio to protect against that, and that's been working out this year. It's helped performance by a couple of percentage points. And you mentioned prior about meme stocks and Bitcoin and things just getting a little bit too out of control. And our style of investing favors more value-oriented companies that pay dividends. And so in that aspect, we were prepared for a lot of the worst that happened in the markets. But I would say the magnitude of rate increases has been a little bit faster than what we would have thought. And I think that's one of the reasons the market is down around 20% is that the Federal Reserve is just raising rates a little bit faster than what everybody else thought they were going to. Inflation's also been a little bit stickier in some ways, and you can blame Russia, Ukraine, COVID zero policy, you name it. But the reality is it's here, and we're trying to deal with it. So we've added real assets to our portfolios over the last few years. That means real estate, farmland, timberland, things that have actually held up really well this year. We also added a long-short equity manager to our retirement accounts, and that fund is essentially flat, even though the stock market's down 20%. So we have things in the portfolio that are doing well, doing what they're supposed to do. But yeah, the stock market's obviously not cooperating right now, but we plan for that ahead of time, and we'll get through it.
So we've talked about common client questions. A very common question is people asking us what we think going forward. Certainly, we have some opinions on where things could go. There are lots and lots of economists and stock traders on TV trying to predict where markets are going. So how successful are people in predicting this, and especially here in the last 12 months?
I think this year is a great year to show how a lot of the experts just didn't see this coming. So If you look at some of the smartest, highest paid people in the world, who work for fancy Wall Street banks, their job is to predict what's going to happen with interest rates, the stock market, and you'll see a Bloomberg headline here pop up, but they all got it wrong. And even the Federal Reserve, which has 400 PhDs and economists on staff, they got this completely wrong. About a year ago, the Federal Reserve was forecasting this time in 2022, they would not have to raise interest rates and we would not have an inflation problem. So some of the smartest people in the world, most informed, spending their life forecasting these kind of things, they can't get it right with any sort of certainty, especially if you're only looking at 6 or 12-month outcomes. So forecasting is kind of fun to look at, and I think probably an interesting idea, but this doesn't work out too well in practice.
So now that we told you nobody can predict things accurately, let's go ahead and take a look at a prediction.
So when I was traveling last week, I was at the Goldman Sachs headquarters in New York City. Their chief equity strategist updated their year-end price target. CNBC picked it up. It was all in the press. So I was in the room when that news broke. But here's their projection. So they think if we get inflation under control and a lot of the bad news is behind us, they think that the market will bottom right around where we are right now and rebound over the next 12 months. If things get worse, recession is on the horizon, inflation turns to be harder and harder to battle, then they think the market could go down another 10 or 15% from here. But then once again recover in the next year or two.
And take that with a big grain of salt.
Exactly.
One person's opinion.
Yeah.
So all of the predictions are out there. We know it can look tempting to clients to gather all this information and then get out of stocks or get out of bonds or exit certain asset classes. It just doesn't work. And so, Josh, you want to talk about why you still own stocks, even with the Fed and inflation?
Yeah, in our commentary we did a little while ago when the Ukraine-Russia conflict broke out, I quoted a stat that the stock market actually performs better during war times than non-war times. And just like that data point, this is also, I think, interesting for clients. In a time period where the Federal Reserve is raising interest rates, stocks have performed at 8%, and in parts of the market have done even better. So emerging market stocks have done twice that, higher than their average return. So just because the Fed's raising rates doesn't mean you should go to cash or get out of stocks. It's not a strong enough signal to predict anything.
So we've talked a lot about stock markets. Trading stocks is a little more interesting and fun than trading bonds, but all of our clients own bonds in their portfolio. And so the stock market gets more attention, but it's been a really challenging year in bonds as well. Talk about the bond market, what's going on there?
So most of our clients have 10 to 40% in bonds, and the closer they are to retirement, the more the income from their portfolio, the more bonds we have. And a year ago, bond interest rates were really low, so we were only getting 1 to 3% returns in our bond funds, which still beat cash at the bank, which was 0. But what has happened over the last 6 to 12 months is that interest rates have gone up a lot in a short amount of time. So now all of our bonds are paying 4 to 8, 9% in some cases. So the part of the portfolio that's in bonds will start to reap this benefit of higher interest payments. So I'm really optimistic about that side of the portfolio. And if you look out the next 12 months, we know what the yields on those bonds will essentially be. And so I think a lot of the pain is gone in the bond market. We've kind of ripped the Band-Aid there. So the next year or two of returns in the bond market should look pretty good.
We're going to put a chart up on the screen talking about bond returns throughout history. Josh, talk about the bar on the right there. It's certainly one of the worst years in a long time. What should we look for going forward?
So the last 50 years in the bond market, the worst return was minus 3%. And this year it's double digits negative. So this is very unusual. Typically bonds are a nice buffer against stock market volatility. But like I said, forward-looking returns on bonds look much, much better now. I'm pretty excited about the investment opportunities there. But this is a strange environment where bonds are down so much. But like I said, the income component's now much better.
So far we've been a little glass half empty. Bad year in bonds, bad year in stocks. We'll flip that a little bit. Let's talk about the positive. What does this look like 6, 12, 18 months down the road with recovery happening?
So I think a lot of the bad news is baked in. There's a lot of pessimism amongst investors, and a lot of the classic signals that tell you when the market is oversold and people are getting a little too pessimistic. A lot of that exists right now. So while we can't predict where the market's going to go, I do think a lot of the bad news is already baked in. And the market in this type of environment will often start to recover when inflation has peaked. And inflation may have peaked a couple months ago. So we get another inflation number here in a couple weeks. The Fed will give us another press conference here in a month or two. So I think if we can get a couple more data points behind us, we could be in okay shape. The forward-looking measures of inflation are starting to cool down, and I think that will start to come into the data over the next couple weeks and months. As long as oil prices remain kind of steady where they are, we could be in an okay place with inflation here in the next couple months.
So the timeline, Josh, you're saying we might be approaching the end of some of this pain, but in that short amount of time until some recovery starts, could things get worse, and what would we do if that happens?
Yeah, I think we'll probably just have a little bit of a rocky road for the next month or two. We need to get the midterm election behind us. It'd be nice to get a couple inflation numbers that were under control, another Fed meeting or two. So I think going into the year, maybe beginning of next year, the markets could have a lot more certainty to them. But if they do go down further, we do have a plan. We have some dry powder. We could make some opportunistic buys. With hindsight, you always look back and wish you would have made buys when the market was low. And it's so hard to do it in the moment because you always feel like it's getting worse. But when things go down, that's the time to be buying.
Thanks for spending some time today with Josh and I. If you have questions about your portfolio, please pick up the phone, call your primary advisor. Be happy to talk more about your plan, your accounts. We're getting towards the end of the year, so we get very excited this time of year. It's end of year tax planning season, and you start talking about tax projections. And a couple months from now, we'll be talking about 2022 taxes and next tax season. So lots of activity outside of investment markets, and certainly here to help address any questions around your accounts and your portfolio.
As my dad always says, stay the course.